Hi everyone. In today's video, we're going to focus on the 7 stocks with the healthiest payout ratios and truly growing dividends. Because, believe me, not all high dividends are good. Sustainability is key. Many people jump into the pool looking only for the highest dividend yield. That is, the percentage of dividend yield relative to the share price. And yes, it's an important factor, but if you stop there, you could be making a serious mistake. A 10% dividend may sound incredible, but if the company is drowning in its payments, if it's undercapitalizing itself to maintain it, that dividend isn't sustainable. It's like a sandcastle, spectacular to look at, but fragile and ready to fall. That's why, in this video, I'll give you the crucial tools to ensure those dividends are healthy and have a promising future. This is where 2 key metrics you need to master come into play: the dividend yield and the payout ratio. The dividend yield is simply the annual dividend per share divided by the current share price, expressed as a percentage. If a share is worth 100 euros and pays 5 euros in dividends per year, its yield is 5%. And at first glance, a high yield is attractive. But be careful. A very high yield can be a warning sign. It could mean that the share price has dropped sharply, perhaps due to problems within the company, or that the company is paying a dividend it cannot afford to maintain. Therefore, yield alone is not enough. This is where the payout ratio becomes important. The payout ratio is the proportion of a company's net profit that is paid out to shareholders in the form of dividends. It is calculated by dividing the annual dividend per share by the earnings per share, EPS. For example, if a company earns 10 euros per share and pays a 4 euro dividend, its payout ratio is 40%. Why is this so critical? Because a healthy payout ratio indicates that the company has enough earnings to comfortably cover its dividend and has money left over to reinvest in the business, reduce debt, or make acquisitions. A payout ratio that's too high, say, above 70 to 80% for most industries, could be a red flag. It means the company is allocating most of its profits to dividends, which could leave it with no room to grow or weather tough times. If the payout ratio is 100% or higher, red flag. It means the company is paying out more than it earns, which is unsustainable in the long run. Therefore, the ideal combination is an attractive dividend with a healthy payout ratio, typically between 40% and 70% for most mature companies, although this can vary by sector. REITs, real estate investment trusts, for example, often have higher payouts due to their tax structure. And the third pillar is dividend growth. A company that not only pays a dividend, but consistently increases it year after year demonstrates strength, earnings growth, and a commitment to its shareholders. Looking for companies that have increased their dividends for 5, 10, 20, or more years ensures you're investing in resilient, expanding businesses. With all this in mind, and with the assurance that the information I'll provide below is for illustrative and educational purposes only, always do your own research, consult a financial advisor if necessary, and remember that investing involves risk. Let's look at examples of companies that have historically fit these profiles and are often considered by dividend investors for their characteristics. Future data through 2025 is an estimate and should be confirmed by your own research when investing. 1. Microsoft, a technology giant that has undergone an impressive transformation over the past decade, moving from a traditional software-focused company to a leader in the cloud and services sector. Its Azure platform, Office 365 Suite, LinkedIn, GitHub, and gaming division, Xbox, provide it with multiple sources of recurring, high-margin revenue. Its dominant position in enterprise software and continuous innovation ensure it has a strong competitive advantage, generating massive revenue and an exceptional ability to generate cash flow. Although not a dividend king, in the sense of decades of uninterrupted dividend payments like some older companies, Microsoft has consistently been a dividend growth company since it began paying dividends in the early 2000s, demonstrating double-digit increases in many years. This growth reflects its strong earnings expansion and ability to scale its operations, making it an example of a mature technology company that rewards its shareholders with growing revenue while continuing to invest heavily in its future. It maintains a remarkably low payout ratio for its size, often in the 25% to 35% range, which is a sign of extreme financial health, as it retains the majority of its profits to reinvest in its core business, research and development, strategic acquisitions, and share buybacks, thereby boosting share value and future dividend increases. It is a model of long-term sustainability. 2. PepsiCo. PepsiCo is a global giant in the consumer goods, food, and beverage sector, known for iconic brands such as Pepsi, Lay's, Doritos, Gatorade, Quaker Oats, and many others. This diversification across its vast portfolio of snacks and beverages provides it with great resilience, as consumers tend to purchase these products regardless of the economic cycle. Its enormous global distribution scale and brand power give it a significant competitive advantage and a consistent ability to generate cash flow. PepsiCo is a dividend king, with a track record of more than 50 consecutive years of dividend increases, an impressive record that underscores the strength of its business and its commitment to shareholder returns. This company is highly valued by dividend investors for its reliability and the consistent growth of its payouts over time. Its payout ratio has historically remained within a healthy range, typically between 55% and 70%, allowing it to reinvest in its brands, innovate new products, and expand globally, while rewarding its shareholders with a reliable and growing dividend. Its predictable business model directly contributes to this sustainability. 3. Medtronic. Medtronic is a leading global medical technology company specializing in the development, manufacture, and marketing of medical devices and therapies. Its products are used to treat a wide range of conditions, from heart disease and diabetes to neurological and musculoskeletal disorders. Demand for its products and services is stable and growing, driven by an aging population and the expansion of global healthcare, providing it with robust cash flows. Medtronic has an impressive dividend history, having increased its dividend for over 45 consecutive years, making it a dividend aristocrat. This long track record demonstrates the reliability and strength of its business, as well as its commitment to returning value to shareholders. Its payout ratio has historically remained within a healthy range, generally between 40% and 55%, allowing it to reinvest substantially in research and development of new technologies, strategic acquisitions, and market expansions, while distributing a prudent portion of its earnings to shareholders. If you find this video helpful, please give it a like and subscribe to the channel so you don't miss our next videos. 4. WP Carey. This is a real estate investment trust, or REIT, that specializes in triple net leasing, meaning its tenants are responsible for the majority of the property's operating expenses, taxes, insurance, maintenance. It operates in the real estate sector with a diversified strategy, investing in a wide range of property types, such as industrial, warehouses, offices, and retail, and distributing its investments geographically between North America and Europe. This diversification mitigates risk and provides very stable and predictable cash flows, as it is not heavily dependent on a single sector or region, with long-term leases and the high quality of its tenants contributing to the reliability of its income. WP Carey has an impressive dividend track record, having increased it every year since its founding in 1998, qualifying it as a dividend aristocrat among REITs. This consistency over more than 2 decades underscores the soundness of its business model and its ability to generate consistent returns for investors. As a REIT, WP Carey is legally required to distribute a large portion of its taxable income to shareholders, meaning its payout ratio is naturally high, often in the 75% to 85% range. This high payout is inherent to a REIT structure and is considered healthy as long as its operations generate enough to sustainably cover payouts. 5. Kimberly-Clark. KM is a global leader in the consumer goods sector, specifically in the manufacture and marketing of essential personal hygiene and home care products, with iconic brands such as Kleenex, Scott, Huggies, Kotex, and Pull UPS. Its products are used daily and consistently, giving it a demand that is resilient to economic cycles, granting it a strong market position and the ability to generate very stable and predictable cash flows thanks to its vast global distribution network and brand loyalty. Kimberly-Clark is a dividend king, with a history of dividend increases that exceeds 50 consecutive years, extreme reliability that is a hallmark of its operational strength, and its long-term commitment to shareholder returns, making it attractive to investors focused on stable income and consistent growth. Its payout ratio generally remains within a prudent range for a mature consumer goods company, typically between 55% and 70%, allowing it to fund its operations, invest in product and marketing innovation, and expand into emerging markets, all while maintaining a reliable and steadily growing dividend. 6. Duke Energy. Duke Energy is one of the largest public utilities in the United States, operating in the utility sector. It provides electricity to millions of customers in several states and operates natural gas distribution networks. As a regulated utility, its revenues and cash flows are highly stable and predictable, as they are based on rates approved by regulatory agencies. This fundamental stability makes it a cornerstone for investors seeking reliable income. Duke Energy has a long and consistent history of dividend payments, having paid dividends uninterruptedly for over 90 years and increased its dividend for over 15 consecutive years. Although its dividend growth may be modest, the reliability and predictability of these payouts make it very attractive to long-term income investors. Its payout ratio generally remains in a healthy range for a utility, often between 65% and 75%, allowing it to comfortably cover its dividends with its stable earnings while investing in infrastructure modernization and clean energy projects for the future. 7. Broadcom. This is a leading technology company specializing in semiconductors and infrastructure software that has achieved significant growth through a strategy of smart acquisitions. Its products are essential for communications infrastructure in data centers, enterprise networks, and broadband devices. Its infrastructure software complements its chip business, providing comprehensive solutions to corporate clients. Despite being a technology company, its focus on high-demand niche markets and its acquisition and optimization business model have allowed it to generate very strong and consistent cash flows. Broadcom is an interesting case in the technology sector. While it doesn't have the decades-long track record of the dividend kings, it has shown exceptionally aggressive dividend growth over the past decade, with double-digit increases year after year. This makes it an attractive option for investors looking not only for a decent initial dividend, but also for very rapid passive income growth in the future. Despite its rapid dividend growth, Broadcom has managed to maintain a healthy payout ratio, often between 45% and 60% of its free cash flow, which is more appropriate for its business. This demonstrates that its earnings and cash flow are growing rapidly enough to support these substantial increases, while also allowing it to retain capital for future acquisitions and product development. As you can see, dividend investing isn't just about chasing the biggest number. It requires understanding the right metrics and having a long-term vision. Don't be swayed by the current yield. Research the company's financial health, its dividend history, and its future growth potential. Companies that consistently pay and increase their dividends are often solid businesses with competitive advantages and prudent management. They offer you not only passive income, but also a layer of security in your portfolio and the potential for long-term appreciation. When building your dividend portfolio, look for companies from different sectors with different yield and growth profiles. This will help you mitigate risk and ensure a more stable income stream. I hope this video has given you a clear and useful perspective on how to approach dividend investing. If you have any questions, leave them in the comments. I'd love to hear them and answer them. Don't forget to subscribe to the channel, and I'll see you in the next video. See you soon.